All right, well, everyone, thank you very much for joining us for what is the, let me make sure I've got a few things actually set up. Let me make sure I've got chat set up and make sure I can let participants in as well. So thank you everyone for joining us for what is the fourth event in our DeFi education series, aiming to educate students, hackers, anyone who really wants to learn about kind of blockchain and DeFi in depth. And we're going through numerous topics, everything from the product stack, which we have today, to building on DeFi, which we have in a few weeks' time, to general introductions and AMAs along the way. And we're finishing, I believe we're finishing with a getting hired in DeFi event. So lots of cool things that are coming up for you to get your kind of teeth into. A word about what DeFi Club is. Let's actually, my screen is being very slow, so why don't we just unplug that? Bear with. There we go. So what is DeFi Club? DeFi Club is an online 10-week cross-university educational series to promote and accelerate the adoption of blockchain and DeFi to students worldwide. It's designed for anyone, so please, if you're joining us for the first time or watching this on YouTube and you're not quite a student or anything, that's absolutely fine. This is designed for people of all backgrounds. We try and go from the building blocks up to kind of teach you everything we can about DeFi and show you lots of stuff that are a taste to get on with at a later date. A few words about Encode. For those who've seen this 3 times before, this will be, I'll try and make it quick, but we educate and back university and hacker talent coming into blockchain. We do this through kind of many kind of aspects. Today is a workshop aspect. We also do hackathons, accelerators. We invest, and we have a dedicated talent arm to help you find a job if you so want it. And we have, I know, loads of fantastic student leaders and hackers here today joining this event and watching. A lot of you I've seen have been watching online and enjoying the YouTube, and that's the whole point of it, to be a resource that you can use to learn about DeFi moving forward in the coming weeks and months. Please do join the Discord. That is a good place for questions. The DeFi channel there is just a single one to advertise, but in general, there's lots of channels if you want to get involved in a hackathon or just in general keep up to date with blockchain and ask questions. That's a very good place to go. So please do check it out. I believe George has put the link in the chat. We're in week 4. We have many good things to come. We have QCarp in week 5, K Warwick in week 7, building on DeFi event, which is more of a technical coding event in week 6, and we also have a big investor coming in week 9 that I can't quite reveal yet, but stay tuned for that. We couldn't do this series without our fantastic sponsors. Thank you to Aave, and we have David today. We'll talk more about that in a few minutes' time. Thank you to CoinMarketCap, thank you to Vega, and thank you to our new sponsor, SushiSwap, who are joining and will be delivering some of the content over the next few weeks. Very much delighted to have them. And those of you there 2 weeks ago heard us talking about SushiSwap and how they epitomize many of the great things about blockchain and being open source and competitive and decentralized. So they are a decentralized exchange, for those of you that don't know. So welcome SushiSwap, and thank you for supporting this series. I'm not going to do too much on, so my style for today, guys, is that I want to go through a few more products that we didn't get to 2 weeks' time. This is a follow-on to the first workshop. We'll do a whistle-stop tour of some stuff we talked about last week. The purpose here is not to be too deep in terms of content, but actually to show you stuff, to show you play around, to kind of show you how cool things in DeFi work, show you products, introduce you to how you'd get involved in them, how they work, how might you put money, crypto money, Ether, stable coins, anything to work. This is kind of the purpose of these 2 events. And again, I will speak for maybe 15-20 minutes or so, maybe a bit less, and then we'll hand over to David from Aave, because Aave are, quite frankly, one of the most innovative companies in the space and protocols in the space, and he can give you a deep dive on lending and Aave and answer all your questions in that respect. So Just to give you a reminder, the best way to understand DeFi is as a reaction to TradFi, and TradFi is basically everything you can associate with a bank. Banks are kind of responsible for a lot of our money and all the products associated with money, from your bank account to lending to trading to anything. But a lot of DeFi should be seen as a reaction to TradFi. And I said this a few weeks ago, but it's broadly this list of things we mean when we talk about DeFi. DeFi means decentralized finance, and it all fundamentally comes back to money, and the fact that money is a bedrock of DeFi. Obviously, it's finance, and that we're trying to build new products based on the fact that crypto allows us to be composable. It allows money to become Legos, bricks. Everything is bricks that you can put together to form new things in a way that completely disrupts kind of what banks do. And I'm not saying that DeFi is in any way a reasonable replacement to banks. It certainly is not at this stage, but it's cool, and it's a cool sandbox, admittedly a very expensive sandbox, to kind of play with financial products and innovate on financial products. And certainly if you're a developer or a hacker, this is so cool, because you can build applications that readily hold millions, and that's quite a cool thing to do. Well, these are some of the slides from a few weeks ago, so we won't kind of go through any of these today. But just to reiterate this point, crypto reimagines finance from scratch based on the idea of programmable money. And we don't need to go through any of that. What I want to get back to is this. So a few weeks ago, we talked about, this is my very superficial kind of analysis of kind of all the stuff in DeFi. Layer 1 are blockchains, the Ethereum being the kind of relevant one here, but there are many, many others. Layer 2, we won't get into, that's for future events. And broadly, you have these kind of 10, and I'm certainly missing some obvious ones out. Insurance, for example, which we're going to talk about today. But broadly, DeFi is first centered on the idea of you having these things called stablecoins. Stablecoins are kind of coins that are not volatile. They keep their value in some way, which is much better for being used as a unit of account, or for trading, or for kind of a means of exchange. And then you kind of build up with things like, you need things like wallets, like how do I literally own some crypto? Where do I store it? We'll go through some of that today. Oracles, how do I get real world information into blockchain? It's all well and good building a financial product, but financial products are invariably linked to the real world. If I have something like a mortgage, or if I have, I don't know, something like my credit rating, or if I'm buying and selling physical items, like I kind of need to know what's happening in the real world, give real world information into a blockchain. Oracles do that. We've got decentralized exchanges, so exchanges where I trade with other people in a peer-to-peer way, or I pull my kind of liquidity in order to to be the house, to be on the other side of bets and trades. We need things like lending that we'll talk about today. Lending is a vital component because lending allows you to go short. It allows you to bet against something. It also allows you to not have to sell an asset, to stay long on an asset, while still getting some exposure, or still kind of getting another take in the short term. And today we're going to talk a little bit about yield farming and aggregators, because I think that's as a cautionary message, DeFi is cool. It's great. Certainly very fun to play with, but it is a 24-hour casino, and that's probably its first use case at the moment. It's being fun, it's cool, and yield farming is a very cool idea that probably is now being used for speculation, as many things in crypto are. This is what happens when you have a 24/7 casino with money involved and kind of very volatile assets, is people want to speculate. That's absolutely fine. So what I'm going to start by doing, if I go out of this, is I actually want to take you to something very basic. And because I realized I got a lot of feedback 2 weeks ago saying, oh, can you just teach me the basics of how I get involved in crypto? And what I always say to people is the first step is you should just go to something like Coinbase. You don't have to go to Coinbase. I have no vested interest in Coinbase or anything else. The point of something like Coinbase is a good place where you can take your pounds or dollars, your euros, and you can buy some crypto very simply. And it's all very safe and secure. They're probably the most reputable blockchain company out there. So 100%, if you just want to buy your first crypto, use Coinbase. This is an easy way. I'm certainly not going to give you any investment advice to the contrary, but or of what to buy or what to sell. But I always recommend just buy little BTC and ETH. This is like just easy, but anything will do. The next thing you're going to want to do is you want to go to this thing called MetaMask. And we introduced earlier and 2 weeks ago this idea of a wallet. We all know what a wallet means in the real world. It means somewhere where I store my money. This is good. We know what this is. In crypto, we need to have wallets that store digital money. And this is just what this is. So MetaMask is something that sits in your browser, this little fox here. And what it allows me to do is it allows me to, let's see if it's going to, see if I'm logged in. Okay, so I have some Ether here. It allows me to interact like a virtual account with various websites and to have my money built in. And I just, whenever I want to kind of send money or do a transaction that involves money, I have to sign it. I have to verify that this transaction is right. This is reputable. I want to make it. So the first step is, if you want to just hold some crypto, please go to Coinbase, just buy some, hold it. If you then want to interact with cool DeFi products that are mainly websites that you go and play with, go and get this thing called MetaMask. It sits in your wallet. It sits in your browser like a plugin, and it effectively is a little kind of wallet. What's actually going on under the hood is this is actually an address where you kind of where your kind of cryptocurrencies sit. We can go into some of the more kind of privacy and safety and custody related aspects a little bit later. But in general, you want to get something called MetaMask. What you also want to get is something called a ledger. Now, a MetaMask is great because it sits in your browser, but you might be saying, what if someone hacks me? Does that mean they get all my crypto? Now, you don't normally keep all your crypto in MetaMask. What you do is you keep in this thing called a ledger. And what a ledger does is it contains my effectively private keys, a very long password, to kind of access my crypto account, my addresses. And every time there's a transaction that goes through, let's say I want to send money to George or David here, I have to sign it. I have to literally press this button and say, yes, I agree, which means unless you have this physical thing, you can't kind of steal my money. So the ledger is a good way, and you can attach a ledger to a MetaMask account such that if you were to try and unfortunately, if you can attach the ledger to the MetaMask and sign transactions that you do on a daily basis with your ledger normally. The next thing to say is to look at a few kind of products, and we talked last week about first of all, the idea of a decentralized exchange, and we can use, now that SushiSwap are a sponsor, I can use them quite readily. So the idea of something like SushiSwap is, traditionally, if you were to go and buy and sell crypto, you did on something like Coinbase, and Coinbase would be the other side of every bet. And they would kind of, if you wanted to buy X amount of Ethereum or Bitcoin, they would say, yes, I'll give you a price for this, and I'll take the other side of the bet for that. Decentralized exchanges basically say, rather than there being one party who offers the other side of every trade, let's see if we can pull people together. And on a kind of basic supply curve, we agree, well, the protocol agrees a kind of basic kind of curve, what the price of the asset should be. There's a very simple formula for doing this. And I offer my liquidity, and I can gain the fees generated by kind of people kind of buying and selling out of this pool. One example is SushiSwap. The other is a Uniswap. And if I go swap, it's very simple. I put in the amount of ETH I want. Let's say I want to, swap ETH for, let's pick a token list. Come on. So let's say I want to swap to find Bitcoin. Let's swap Aave. If I want to swap Aave for ETH, I put in, I want to swap 5 Aave for some ETH. It gives me a price. And what's happening here is it's taking out of a pool that people have put in their own Aave and ETH to. And it's very simple. The price of Aave relative to ETH is how much Aave is in the pool relative to ETH. We won't go into, there's obviously worlds in which you're kind of, you lose money if you're a liquidity provider in this situation. Because of course, if the assets, you're basically long the assets, you're betting the assets will kind of at least keep their current price, and you'll make money off the fees. Of course, you can lose money in this situation, but we won't go too deep into that now. All this is a simple way by the only people who are kind of offering, it's not peer-to-peer, what people are doing, they're offering their liquidity for a fee, for a premium, and as a result, I get to interact with kind of and buy stuff off this pool, and I'm not dealing with a centralized kind of party in the meantime. So this is kind of decentralized exchanges. I now want to talk about, we've talked a lot about decentralized expenses last week, and we'll talk about lending in a minute with Aave, but I want to talk about Yearn, because Yearn, I think, symbolizes a lot of the stuff that's happened with DeFi over the last kind of year. And what Yearn basically does, it's a liquidity aggregator. So you've just seen, I've kind of explained in a boxed fashion how liquidity works. If I want to kind of, where's the liquidity bit? If I want to kind of get an interest rate, I put in kind of 2 tokens. I say kind of ETH and something else, let's say ETH and Aave. They then use this pool of tokens to kind of buy, and the people can buy and sell from. The price of one asset is the ratio of that asset in the pool. So if lots of people bought Aave, the price of Aave relative to ETH would go up. But there's lots of different ways, and you can get lots of different interest rates doing this. And you need something to kind of aggregate them together. And the first one was kind of Yearn and YFI. The reason why this was so popular is 2 things. One, it's a cool product that does cool things. The second thing is that it introduced this idea of liquidity mining and yield farming. So liquidity mining basically says this. I need you to provide liquidity because the reason why a central exchange needs to be centralized is it needs a lot of money. It needs to be an organized force in making sure that every trade can be serviced. Second of all, the idea, the way you can kind of bootstrap this is to say this. If you put liquidity onto my platform, I will give you a free token. Now you might be saying, it's a free token, it's not worth anything. Crypto has an uncanny habit of a lot of speculation happening about early stage tokens. People are kind of primed to bet they go up. So let's say this token does, for whatever reason, is speculated upon and does have a value. So you're giving someone for free, pretty much, something of value. So this will encourage a lot of people to put liquidity in and get more of this token. And you can do some kind of circular / slightly Ponzi things where you ask people to put liquidity in by buying the token itself, to put it into another liquidity pool, and it becomes a self-fulfilling prophecy. The more people do that, the higher the token price goes up, which means the kind of higher people's rewards are, which means the more people want to do this, etc., etc. But in the basic kind of system is, I will give you something for free, a reward, or just a reward, not even for free, if you kind of provide liquidity. And because of this, you get a lot of people kind of farming, looking to kind of do this. Where can they kind of go to kind of do this sort of thing? And if you want to kind of have a list, I talked about this last time, of like all the cool things, here's like all the farms right now where people are saying, look, we need liquidity. We need people to bootstrap. We'll give you free rewards. The risk you take, sometimes you take some risk. Sometimes it's literally just a signaling effect. We want you to put that money on there for signaling. An example of this is Float Protocol. Float Protocol I can talk quite freely about because they were in the Encode hack that just finished. And let me see if I can find. And the cool thing about them is I think they're the biggest farm right now. So these are, by the way, these are guys that came out of Encode. They went through our hackathon. Like you could be the next Float Protocol if you so wanted to be. So let me. If this is obviously going to take a ton of time to load, I made sure to preload most of my things. But let's go. Yeah, so this has 1 billion locked up in it. So what this means is, so Float are actually not using this. Normally, protocols would use this liquidity for something and say, okay, we need this liquidity to fuel a trading platform or fuel lending or to make our system work. Float actually said, no, we just want you to do it as a signaling effect to other people that this is worth something, and we'll just give you some free tokens in return. So they did it purely as like a signaling kind of marketing device. But a lot of people use it to bootstrap liquidity. Now, this is cool. This is obviously, it obviously works. It works in the short term if people think the token that they're getting for free is valuable. Obviously, in the long run, people will value these early stage tokens less and less, and the rewards are less and less. So yield farming and liquidity mining doesn't work. But if you just want to provide your liquidity and get a bit of kind of some money for it or some hypothetical rewards in return, then then this is a nice way to do it. What I want to talk about next, before we go into kind of some other bits, is insurance. So obviously, one of the main risks of liquidity mining is smart contract risk. So we talked a few weeks about how smart contracts are the thing that power this. This is basically just code that says, if this happens, do this. And it's linked to money, and you can't reverse it once it happens because it's blockchain, so it's decentralized. So you'd have to get the agreement of everyone, and everyone's not going to agree. It's not in their interest to do so. So once the code executes, it can't be changed. This is the basis of smart contracts. That's why they're contracts. They're legally binding, or they're at least they're codingly binding. So one of the problems is that when you take, let's say I went to Float protocol and Float failed. Maybe, so I put my money in. So let's say people have put 200 million in the ETH pool. And let's say for some reason there's a bug and all this ETH is lost. Do you think, shit, that was a terrible idea? This is one of the risks. One of the ways you can offset this risk is insurance. You can literally get insurance that if there is a failure of the smart contract, pay out. And this is another example of what is a complex financial product that can be kind of rebuilt in kind of crypto with code. If you can write something down on paper, you can write it with code in quite a clean, elegant way. And we have an AMA with Hugh next week. If any of you wants to kind of find out kind of more about kind of how insurance work, he comes from a traditional insurance background. That's next Wednesday. Now, can that bubble please move? So the way Connexus Mutual works is I go, this is all kind of app-based. This is going to be very slow now. I buy cover. You can buy, it tells you which kind of protocols I can buy cover for. So let's say I want to buy cover for, I could actually buy cover for Coinbase. You can work out how much ETH you get covered for, and it will tell you a kind of price for doing so. So it's quite a nice, simple model. And the cool thing about blockchain is you can, a lot of the time, the way kind of big financial products or companies work is they make money by being the other side. They make money by kind of facilitating the market. And in Nexus Mutual, you could be the other side of the market. You could own the token that provides the mutual, which is the backup kind of funds to kind of kind of benefit from the profits of this insurance thing. It's user owned, it's completely decentralized. So that's, if any of you kind of are interested in insurance, this is a cool thing, and there's many others such as Cover and Armor that you can kind of have a look at. Another thing to kind of, if you want to kind of look into one of our future AMAs to come, is we have Synthetics that very much like Vega, who is sponsoring, they do derivatives. And derivatives are needed because sometimes you don't just want plain vanilla like asset that does X, just Ethereum. You might want a future product on that, a bet on what the price will be in 3 months, 30 days. You might want to kind of bet something's going down. You might want to do all these kind of things. And Synthesis provides the infrastructure for that. And we have Kane Warwick coming to speak to us in a few weeks' time. It's by the way, he's Australian, so this is the earliest event we've ever done. It'll be 10 a.m. On the 14th of April. So we've talked about kind of yield farming, we've talked about insurance, we've talked about kind of general how you get set up with kind of blockchain. And in general, those were the kind of topics I wanted to cover just because they'd come up in kind of feedback and questions over the last few weeks. Now I want to go back to what I see as I say, one of the two most important things in kind of blockchain, decentralized exchanges and lending, and really go to Aave and let them kind of, let David kind of tell you more. But Aave have been phenomenal for the space, a lot of amazing applications we've built on, and they provide a whole kind of lending infrastructure that you can kind of take advantage of. You can use if you just want to get an interest rate, or you can kind of build cool, what's called no loss products on top of it, where you can use the interest rate to kind of fund other cool things by putting money. Let's say you had I don't know, you were a university or a society and you had some pot of ETH that wasn't doing anything or some savings, you could put it into Aave, get an interest rate and use that interest rate to pay for, I don't know, the yearly yacht party. A society once paid for a yacht party. We'll not reveal which one did it. It could be your yearly yacht party, for instance. And there's a whole kind of many cool things you can do around this idea of using the interest for community good. But I'm not the best person to talk about lending and why it's cool and why you want to kind of know more about it. I'm going to hand over to David now, who's the expert here, who's going to tell you more about everything. So David, do you want to go camera on, presentation up, and tell us more?
Sure. Thanks for that intro. Let me see if I can share the screen first. Where is it? You can see the Aave slides now?
Yep, all good.
Awesome. Cool. Yeah, so as Anthony was saying, my name's David. I'm from Aave, developer and builder. And I'll go over a quick introduction relatively quick introduction of Aave, what it involves, the lending aspects, and what's new and interesting in Aave as a protocol. So for those that are newer to the space, it's called a liquidity protocol, also known as a lending protocol. And what that means is, on one side you have depositors, and they deposit into the protocol. They interact directly with the smart contracts, and they earn interest because they deposited in the protocol. And on the other side, you have borrowers who can take stable variable interest rate loans, and they can repay those loans whenever they want. The difference the difference with normal lending is that you're interacting with a smart contract. There's a pool of liquidity that you're interacting with. It's mostly automated, 24/7. There's no branches to go to. There's no loans to match up with. You just deposit, earn interest, and you can take loans whenever you need. Besides the depositors and borrowers, we also have price feeds, which ensure the prices are accurate, and that the health of certain positions are accurate according to the prices in the market. We have the liquidators, and the liquidators are decentralized third parties, just other people in the industry who've created basically bots that will liquidate loan positions that are in danger. And they're incentivized to do this because they make a little bit of money off each liquidation. Then also we have more than 100+ applications and protocols that are integrated in some capacity with Aave. So just going over Aave as a protocol, there's more than $5 billion total value locked into Aave. We launched onto mainnet in early 2020, January 2020, and since then it's been a crazy increase run up, and it's just grown massively. And let's say, was it last week? I think we just announced the AMM market, and like Anthony was saying about SushiSwap, when you deposit liquidity into a place like SushiSwap, you receive these LP tokens, which symbolize the liquidity that you've added to that AMM, or the automated market maker. And Uniswap is the same, and Balancer protocol is the same as well. So what we allow now with this AMM market is that the user, let's say they provide liquidity. At the moment it's just Balancer and Uniswap, but it could be something like Sushi in the future. They provide liquidity to that AMM, then they receive the LP tokens. Now they can take those LP tokens, deposit it back into Aave, and use those LP tokens as collateral to borrow more money. So then that enables them to make more, essentially use their assets twice. So it sort of creates more efficient markets and a more efficient use of capital. But that's jumping ahead a bit. Going back to, I guess, the version 2 protocol features. Like most lending protocols, we have the obvious ones like depositing, which you earn interest for. There's borrowing. Then we have credit delegation, flash loans, and governance features that I'll go through. And we support more than, I think, 25 or 30 assets in the protocol. So there's quite a lot to do. So with earnings, the way I normally do these presentations is I explain them in simple terms. It's called ELI 5. Explain like I'm 5 years old, and then it'll progressively get more complex. So if I was explaining to a 5-year-old, I'd say that you let other people borrow your money when you're not using it. To a 15-year-old, I'd say that you deposit your money, earn immediate interest on that amount, and you can withdraw at any time. And for more crypto native people, what we essentially do is that we tokenize your deposit. We call that an A token. So if you send 100 DAI, you receive 100 A DAI in return. And that one A DAI is always redeemable for 1 DAI. And the account holding those A tokens accrue interest immediately based on protocol parameters. So you'll see that the balance of that, your A tokens tick up immediately because they're earning interest. And this is sort of the schematic from before, where a depositor deposits some asset into the protocol and they earn interest as a result. For borrowing, similarly, on the other side of depositing, you have borrowing. So if I was explaining to a 5-year-old, you're borrowing money whenever you need it. To a 15-year-old, you're borrowing money, but depending on how much you've deposited in the system. So it's a collateralized lending protocol. So that means for for you to be able to borrow any type of money, you need to have put up some money into the system, and you can pay back these borrowers anytime. And in a crypto native sense, we use the A tokens as collateral to borrow any of the supported assets at either stable or variable interest rates. And this is a schematic again. The important part here is that the person that deposits into the protocol is also the same person that takes the loan, because because it's an over collateralized protocol that enables them to make those borrows. Now go into a bit more advanced features, credit delegation. So credit delegation is sort of like borrowing, but you let other people borrow your money. And if I was explaining to a 15-year-old, I'd say that you deposit on Aave to earn that deposit interest, but you can earn extra interest if you want by managing your own loans to other people. So what that essentially means is that because you deposited into Aave, you now get a certain credit line, and maybe you have no usage for borrowing money, but you can essentially delegate that credit line to someone else, and they can borrow funds, and that person or people can do whatever they want with those funds, and then you can decide to charge them extra interest offline, enforce it through a legal agreement, or enforce it through a smart contract. And so in schematic form, you have one person that deposits into the protocol and earns interest, and then the other side is someone else that borrows. And the important part here is that the borrower, they didn't have to put any collateral into the protocol. So that means this is essentially an uncollateralized loan from the borrower's perspective. Of course, from the protocol perspective, there's more collateral than borrowers in the system. But this is an important use case that really opens up the design space a lot. There's many B2B applications that could be created from this. And flash loans are another interesting area where, similar to credit delegation, they're similar to borrows. However, if I was explaining to a 5-year-old, it's essentially free money that you have to pay back nearly immediately. In banker terms, because I think bankers will sort of find this a bit confused. I mean, everyone sometimes finds this confusing, but essentially it's an unsecured fixed term loan that goes for about 14 to 15 seconds, and that's the block time of the Ethereum blockchain, with a very low fixed interest rate of 0.09%, and that's set by governance. And that's a protocol parameter that governance controls, and that the bank in this case is Ethereum or the Aave protocol. It can always collect that expiry, so there's essentially no risk to the protocol. And in more complex terms, it's literally an uncollateralized loan supplied by the Aave protocol, where the amount borrowed, flash loaned, and plus a small fee needs to be repaid by the end of the transaction. And the reason why you'd want to do this is because you can execute any arbitrary code between the flash loan and repaying the flash loan. And if the flash loan is not repaid, and then the state of the blockchain just reverts, and it's like it never happened. Let me just have a quick look at the chat, see if there's any questions.
We can deal with all questions at the end. I think that's the easiest way, not to disrupt your flow.
Yeah, all right, that works. So in diagram form, this is sort of a flash loan diagram. The important part here is that everything above the purple line happens, and the caller, or the person that starts the flash loan, pays associated gas costs. So whether it succeeds or fails, you'll see someone calling the flash loan function on the blockchain. Everything below the purple line, if the flash loan debt is paid back and then it goes through, like all those operations happen successfully. If the flash loan debt is not paid back, whether intentionally or unintentionally, then all of that stuff below the purple line essentially doesn't happen. It gets reverted, and the borrower still pays like some sort of gas costs. But that's quite an interesting dynamic. It's sort of you get to simulate a transaction in a way, and if it's not profitable, if it doesn't do what you want, and then it just doesn't succeed, and it's like it never happened. So it's quite an interesting concept to wrap your head around. A real world use case of flash loans is something I created a year ago called collateral swap, and we don't need to dive into details, but essentially the reason why you'd want to do this, or why it's useful, is because you're bunching like 5-6 transactions into one transaction. And the important part is that you're not capital constrained. So normally if you wanted to do these transactions, these 5 transactions or so, you'd need a certain amount of capital to start with. Here, you don't need that certain amount of capital. You're able to call that flash loan function, do whatever you need to do. And as long as you pay back that loan, the flash loan, by the end of the transaction, then everything's good. And the more obvious use case of flash loans is in arbitrage. So this is an example of an arbitrage transaction. Essentially, arbitrage is buy for cheap somewhere, then sell for higher on somewhere else. And normally, for the large arbitrage transactions, there normally depends on the amount of capital that you have. And say if an arbitrage transaction is only profitable if you can execute millions of dollars, then you need to have those millions of dollars to start with. But with flash loans, it's not capital constrained. So anyone, even like a 12-year-old in their basement, has access to hundreds of millions of dollars to take these arbitrage opportunities if they want. So it sort of levels the playing field a lot in the DeFi space, which we've seen over time. And specifically in version 2 of the Aave protocol, there's many new features, but one of the new features related to flash loans is that we allow batching of flash loans. So that means that you can flash loan multiple assets in one go and pay them back at the end of the flash loan. And that's important because now you can do many more transactions all at once instead of swapping assets midway through. And moving on from the traditional, I guess not traditional, but moving on from the lending part of the protocol, another important part of the protocol is the governance. So explain to a 5-year-old, that means it belongs to everyone. Explain to a 15-year-old, it means that anyone who owns the Aave token can help govern the protocol. And explaining DeFi terms, Aave is moving towards decentralization. A lot of it's already decentralized, but this decentralized future means that token holders, Aave token holders, will be able to vote and govern the protocol. And that includes everything from asset listings to protocol upgrades to protocol parameters to essentially everything. And so I'll go through an example of the decentralized governance in action. So Curve Finance is another protocol in DeFi, and Charlie was one of the guys on the team. He made a proposal on the Aave governance forums, saying, hey, please list CRV, so then people can, deposit it as collateral and all that sort of stuff. Made the proposal. Julian, who's also from the Curve team, he posted on Twitter, and one of the special things about Aave governance tokens is that you can delegate not just your voting power, but you can also delegate your proposition power. So that means if you don't have enough Aave tokens to make a proposal, because it can be quite costly, then you can ask people to delegate their proposal power to you, so then you can gather up enough power, and then you can make this proposal on chain. Right, so Julian was, he's followed quite a lot on Twitter, and he said, delegate your prop power to this address, and then eventually they were able to make that proposal, and it was voted through successfully. So now the Curve token is listed on the Aave protocol. The same thing happened with the Balancer token, and there's a few other tokens in the pipeline that are also currently going through the governance process. So that's sort of an overview. It starts off chain on the governance forums. Some details are worked out, and then the proposal is created from someone with enough proposal power. It's voted on, and then it's automatically queued and executed. And then essentially that's like the upgrade of the protocol. And like I mentioned, there's tons of proposals coming through currently. I think also GUSD, which is the Gemini USD token, that also got listed through this governance proposal, like this governance workflow. And it's quite interesting because one of the Winklevoss twins, they had posted on the governance forums, and they advertised on Twitter and all that sort of stuff to get it listed, and it worked quite well. The other important part of governance is the staking. I won't go into too much detail, but essentially Aave token holders are able to stake the Aave token if they want to into what's called the safety module. And reason why they would want to do that is that firstly, it's like a backstop for the protocol. So if something bad happens within the protocol, like something gets hacked or funds are lost somehow, then up to 30% of the funds staked into the safety module can be used to, make sure everyone is whole again. And that helps protect the protocol. And for taking on that risk, the stakers receive quite a high interest rate in Aave in return. And it's been quite interesting because we released that probably early this year or late last year. And currently you can see here on the Aave staked Aave token, there's more than $1 billion staked. And then also there's another version of the stake token, which is a balancer pool token, and that's nearly $300 million. So there's like $1.3 billion that's currently staked in the safety module to help protect the Aave protocol, which means that the Aave protocol is one of the most well protected protocols out there, because up to 30% of that can just be taken away and to help protect the protocol, which is quite an amazing thing to see as well. And then finally, I'll just go over some of what we call the Aavenger Fam. There's some interesting companies and products that have been built that integrate Aave somehow. So DeFi Saver, hopefully, if you end up into the DeFi space, you probably make use of DeFi Saver. They're really useful service, letting you, take care of your positions, swap positions between different protocols rather easily. And under the hood, a lot of it, they use flash loans from Aave. So we really like what they've done there. Furo Combo is another one where I mentioned that flash loans, you can execute any arbitrary code, but that means that you have to be a coder to understand how to code the smart contracts. But Furo Combo created essentially a drag and drop editor where you can drag and drop these like flash loan block onto here, then say, okay, flash loan this amount, then do this and do that and do that. So that enabled other people, non-technical people, to take advantage of arbitrage opportunities if they found them. And then Yearn Finance, of course, I think that was mentioned previously as well, but in Yearn Finance version 1, they also use credit delegation, the first version of credit delegation, and that enabled their A-Link vaults to essentially yield more than they would have if they didn't have the credit delegation, because it gave them access to more funds to earn yield. And then finally, Aave, which is really cool. It's in the NFT space. It bridges the NFT space with DeFi, because each of the Aave, which is the NFT, each of the NFTs underlying the NFTs are a bunch of A tokens. And as I said, those A tokens are it's tokenized deposits. So that means they're earning interest. So as you play the game, you're also earning interest on the underlying, which is pretty cool. And it's a cool way to save but also have fun. And these NFTs end up having some inherent value instead of just being sort of speculative value. Yeah, and there's more than 100+ integrations in various services and wallets and whatever else. If you want to find out more about Aave, hit up the Discord or documentation links, but especially our Twitter and Medium is probably where you'll find most of the information. So that's all the content I had.
Awesome.
Maybe we can jump into some quick questions.
Yeah, let's we've got a few minutes for questions. So how about I read them out, and then we can decide if I'm going to answer or you'll answer, David. Can you please explain the tokenomics to these DeFi protocols? For example, token issuance, how developers are incentivized to create protocols, how is the model profitable to the CEO? Well, actually, I'm going to hand over to David, because Aave transitioned to a new token in the last year, and so probably had to go through a lot of the tokenomics and all this stress and thinking. So can you talk to me how maybe a little bit about the process, David, of how Aave kind of came up with their token economics?
Sure. I mean, it's firstly, it's done very carefully and thought through very very carefully and in detail. But there's no real like one size fits all. I mean, the whole point of, I guess, tokenomics or implementing these sort of game theoretic mechanisms in tokens and how to retain value, increase value, or things like that. It's very specific to the use case, right? So Aave's tokenomics is totally different from some other protocols tokenomics. So there's no real like standard way of doing it. Generally, a lot of people would have their input, and you'd probably run some simulations, and yeah, I'm not sure if that answers the question.
No, that's good.
Yeah,
and just to add my kind of 2 cents, it always depends on what you're trying to achieve, as kind of David says. The token for a lending platform might be very different to, I don't know, a token that's purely designed for governance, for instance, or the kind of many different ways to kind of structure things. We perhaps we'll touch on that a little bit more in kind of future events, and certainly you can ask the founders of the protocols we have coming up in the next few weeks, Byron, kind of specifically how their approach was to it. By the way, just to answer the last bit, how's the model throttles the CEO? Team tokens is a very different thing in crypto because protocols are so much bigger. In a normal company, a normal startup, you expect the kind of core team to have maybe around 30–40% of the token by the time it reaches full maturity, the stock. In crypto, because again, it's a decentralized huge network, typically the team, it's in the single-digit percentage, if that. And again, this is to enable, there's some variance on this number, but this is to enable the fact that the team are a vital part, but not the be-all and end-all of the protocol. They shouldn't have a monopoly over it. So it's a very different model, but valuations are accordingly because you're doing bigger systems. So teams are well compensated if they do a good job. Does Aave work on other blockchains?
Not currently. So that's I guess part of the L2 sort of conversations, L2 sidechain conversations. But yeah, we haven't really announced anything in that regard yet.
Awesome. Aave and real estate as collateral. How's that exploration going?
Sorry, say again.
Aave and real estate as collateral.
So I think a long time ago we announced that we were working with Realty. Was it Realty? But yeah, there's definitely like that. That goes into sort of the institution / private market or alternate market type conversation. So, like I mentioned, Aave has a main market, then also has the AMM market. So the strategy has always been to like create more markets. So any sort of future real estate market will most likely be a separate sort of tokenized real estate market because there's different oracles, different pricing mechanisms, different risks and things like that. But yeah, nothing else to mention in that regard at the moment. But hopefully soon you'll start hearing more about that sort of stuff.
Awesome. Question: what is the state of DeFi and other blockchain platforms? Maybe I can take that. I think in general, there's Ethereum is the first mover and all this sort of stuff. Other blockchain platforms have done copies, or people have done kind of, if they've seen, then this is not a bad thing. Copies are good in crypto. They've done kind of copies of Aave, copies of Uniswap, copies of Sushi, copies of derivative platforms, stablecoins, etc. But I think I'm right in saying the usage isn't quite there. There are some cases where there's very good Ethereum bridges, so where you can go from Ethereum to another blockchain for whatever reason you might want to do. I think some of those doing quite well. Avalanche is a good example of that. I think Harmony have a bridge as well. Most Near have a bridge. But in terms of the products are there, innovation is not really there. The innovation kind of seems to happen on Ethereum from my purview, and the user base in inverted commas. Although, by the way, there's not actually that many. There's a lot of capital on DeFi, but in terms of number of users for kind of, Aave is a great exception, but for the average DeFi protocol, the number of users isn't that big. We're not talking like billions of users here. We're talking kind of tens of thousands. Maybe hundreds of thousands on a good day, but probably more in the tens of thousands range, which is actually for not like there are apps on the App Store that have more users than this. DeFi is still actually a lot of capital, but still at an early stage. Ethereum is kind of ahead. There's a question about how is the Aave team paid, which I don't really think is like, Byron, like you can figure out, like people get salaries. Like we don't need to go into that. What is the status of regulation of blockchain and DeFi? I can take that. In general, there's not been too much so far, mainly because these are quite exotic things. It's hard to work out how you should regulate this stuff. The main thing is going to be around KYC and AML, if it does come in and requirements for kind of protocols to do so. At the moment, there's been no specific legislation about it. and there's normal rules apply. You have to be very careful about a security or token distribution to make sure you comply with all the necessary regulations if a protocol does decide to do that, and you should not. Blockchain should not be used for any money laundering. It's kind of, blockchain's a very stupid thing to money launder through because everything's public. So you can kind of trace transactions really clearly from source, and kind of regulators are kind of, I think, used to doing this now. But expect more stuff, particularly around stable coins, particularly around kind of KYC and AML, which is just making sure that money laundering doesn't happen, or money associated with crime doesn't get into kind of crypto systems, into the traditional banking systems. Next question from Alessandro: what are the plans to support under-collateralized lending, David?
Yeah, so I mentioned that we already do have undercollateralized lending and uncollateralized lending in a certain form. So undercollateralized lending is essentially credit delegation, where the borrower has no collateral. Of course, the credit delegator put up collateral, but then flash loans is where there's also no collateral because you're just taking the flash loan. So those are the only flavors that Aave supports at the moment. I know there's ongoing experiments in the ecosystem, but none of them have really succeeded. There's a lot of potential risks and attack vectors with uncollateralized lending. So that sort of side of stuff is still in experimentation phase.
Okay, very good. Why isn't DeFi integrated into banking apps like Monzo and Revolut? I was going to say this is probably an AML question. They don't want, they have to be very careful what products they allow kind of people to use because they're highly regulated institutions or kind of young startups. So that's the reason. Maybe I can ask David. David, are there any plans that Aave will be integrated as a kind of savings and interest rate generator for kind of consumer applications?
I mean, we'd love to. There's Aave Limited, which is a UK entity, and that has a certain license that is similar to the Revolut and Coinbase license that they have in the UK. So we haven't announced anything around that yet, but maybe in the future there might be something around that.
Awesome. So a couple of questions here. Will Uniswap v3 have any consequences for Aave? And will Aave be adopting a similar delayed open source approach? I believe Clara is talking about the fact that Uniswap are not open sourcing their code for a couple of years to avoid a kind of issue situation. So yeah, what do you think on those two questions?
Yeah, I mean, so the first one, I mean, personally, I love Uniswap and I use it like nearly daily. So I think Uniswap v3 is awesome. I don't think there will be any immediate consequences. It will make, because I mentioned the AMM market and we currently support Uniswap v2, to support Uniswap v3 because they changed the way the LP positions are essentially tokenized. That creates some more complexity. It is still possible to do like a Uniswap v3 AMM market in Aave. But it just makes it a bit more complex. So that's the only real consequence that happens for us. And then, I mean, I know some people in the team didn't really like the delayed open source approach. For me, I'm sort of neutral on that personally. Like, I think it makes sense. I understand where they're coming from. They need to protect their work as well. But yeah, there's no plans in Aave currently. I'm pretty sure people in Aave wouldn't want to do that with Aave. But I'm not part of that's more of a question for business and the core dev team. Yeah, so.
Very good. Just for context, everyone, Uniswap v3 is the latest version of Uniswap, and it's mainly completely changing the way loads of changes, one of which is completely changing the way they do liquidity pools. And allowing you to, at the moment, what happens is if I want to offer liquidity, I offer, let's say I want to provide ETH and Aave, I put them in an equal kind of proportions, and they get kind of used for the pools at any price points. Now you can do things like define the price range you would like to provide liquidity for, which completely changes the way liquidity curves work. And for those kind of economists among you, it basically allows people to set their own kind of aspect of the supply curve, which is getting into really cool stuff. And many things around that. But what they did is they said, okay, we've done a load of kind of, and they also have introduced layer 2 into Uniswap. Maybe we can actually touch on that with Aave in a second. They've introduced layer 2 into Uniswap, so that to kind of make transaction kind of times faster, bring down the costs. But what they've said is they've made all these changes, and we're not open sourcing the code, which is typically what a blockchain protocol will do. They open source this code from day one, so it's public, it's very auditable, and you can, technically, if you don't like it, you can fork it and start again. In this case, Uniswap have said, nope, we're going to keep it private for 2 years, and then we'll open source it so that no one can kind of steal on all their work. So that's the context. David, what are the plans for kind of Aave and integration of layer 2s?
Just one clarification on the Uniswap license, just so these sort of things aren't propagated. But essentially it's still like effectively open source. It's just like you can still view the code and see how it works and learn from it. The thing is that you can't use it in, like, you can't do like a C# or you can't like copy and paste it and use it in a commercial sense. But it doesn't affect integrators. It doesn't affect people that build on top or want to use Uniswap in some way. It more affects if you want to copy and paste Uniswap and make money from that copy. But you can still use it as an educational tool and learn from their best practices. Just to make that clear. And then after 2 years, then that finishes. Then you can copy and paste it if you want to do that. But from the Aave perspective for L2s, we haven't actually made any. The only announcement we've made around L2 is that we're investigating L2s, and we should deploy or have like an L2 soon. I'm not sure how much more I can announce around that. I think our approach is maybe slightly different from other protocols. Let's say like Synthetics, they bet pretty big on like one L2, and they just sort of went hard on that. And I think our approach is slightly different. But also, Synthetics is a very different protocol from Aave, which is like a lending protocol. And lending protocols, a lot of the value comes from huge pools of capital. Because that's where the interest rates, and when you're borrowing assets, you want to borrow good interest rates, and you want to borrow many assets or a lot of assets, a high volume of assets. So those sort of factors come into play. So it can be quite a different calculation for Aave than other protocols.
Good. Awesome. Well, thank you, everyone. I think that's it for questions. Thank you, everyone, for joining us today. David, thank you so much for as ever, I look forward to your presentations. They're so crystal clear and informative. So thank you very, very much.
Awesome. Thank you, Anthony.
Awesome. And then for everyone, next week, Nexus Mutual. Week after, building on DeFi 1, which is more technical kind of coding kind of event, followed by Synthetics the week after, and building on DeFi 2, then an investor AMA, and then we finish off with getting hired in DeFi. So everything, all the content for this will go up on the Medium, on the YouTube, on the Discord later tonight, or tomorrow morning probably. And if you have any questions in the meantime, feel free to reach out to myself or George or anyone from the Encode team. They'd be more than happy to kind of help you on your DeFi journey, even if it's just setting a wallet up and just answering basic questions. But in the meantime, David, thank you again. All the students, all the researchers, all the hackers, everyone who's watching this on YouTube, thank you for joining, and have a good evening, afternoon, morning, wherever you are.
Awesome. Thank you. Bye-bye.
Thanks, David.